Next is Karthik Vararajan concerning lithium. Now we have discussed about Green Tech Engineering Limited. Green Tech Engineering Limited is a successful mid-sized renewable engineering company in India, has completed the multiple solar and wind power projects domestically and they now aim to expand into the South Asia. To fund this international growth, the company plans to raise $150 million through a mix of equity and debt, while managing financial, regulator and operational risk. Green Tech has engaged a merchant bank to advise on capital structuring, project financing, underwriting and strategy partnership, ensuring both investor confidence and long-term sustainability.
Problem of the case: what mix of equity and debit would be optimal for Green Tech Energy?
Yeah, first problem is optimal mix of equity and debt. When a company is going to expand to an international level, they have to plan for the finance. When coming to finance means when a company raises from capital means they use the two terms. One is debt and another is equity. When coming to asset allocation, many of the major companies going to a capital raising, they will go with the equity. They will give more preference for then to debt. They will allocate 60% for equity and 40% for debt. When we raise the capital means we can use for equities IPO, initial public offering, which should everyone know. And then another is private placements. Private placement is when a company is willing to raise the capital, they doesn't go for IPO. They will go with an investment bank and major investor shareholders. They will approach them. Then the high net worth individuals, HNI, they will invest in the company. And then these are the two things which we can able to raise in capital and equity. Then coming to debt, 40% of debt. For this debt, we can raise capital from loans, bonds, and bonds. For this, many banks are providing loans to the company, and then when coming to bonds, we can get money for fixed interest rate. The interest is getting low. This is an optimal mix of equity and debt to raise the capital.
How can the merchant bank mitigate risk in international expansion?
Yeah. Next, when a company is going to an international level, they have a lot of risk. Okay. For to mitigate that risk, first and foremost is the financial risk. When a company is going to an international level, there is a first and foremost the company is facing. For that financial risk is under currency risk and then interest rate risk. Currency rate risk is for how we can mitigate. That means we can put a forward contract to that particular country for that exchange rate of currency. And to next is the interest rate risk. Coming to interest rate risk, there is a two interest rate. One is a fixed and another is a floating interest rate. We have to go with the fixed interest rate because then only we can able to plan to repay that loan. So fixed interest rate risk we have to go with the fixed interest rate, and the currency rate risk we have to go with the forward contract. And coming to another risk is for operational risk. When we go into the another country, international expansion means we have a lot of operations here because we are in a renewable energy in solar and wind energy. We have a lot of operations in this company. So we will go with the partnership with a local firm which is already located in the native of the company. So for this, how we navigate the risk means which is we can able to reduce the risk in a regulatory and the controls and the supply chain. These are the risks we can able to mitigate in operation level. And coming to political and the regulatory risk, because in every country there is a president, there is a political party. This is some major risk for the going to international expansion. On that time, we will get some insurance. Insurance means MEGA. MEGA means Multilateral Investment Guarantee Agency. This is an agency which is in a world level. They will give insurance like political risk insurance for that company which is going to an international level. The agency is linked with the World Bank. This is one way of to reduce the political risk in the other countries. And coming to another is the portfolio risk. Portfolio risk, when the real estate companies plan to expand to an international level, basically particularly focus on Southeast Asia. There is many countries. Portfolio risk is we have to diversify. We don't want to depend on one country. We have to get a good relationship with another too many countries to avoid a dependency of one country.
Which service should the bank prioritize to maximize project success and investor confidence?
It focuses on capital structuring to raise funds and effectively provide risk advisory to manage international challenges, arrange project financing for affordable loans, help restructure the company to improve efficiency, optimize the project portfolio to reduce risk.
And I conclude the case study. Green tech energy is several solar in India. When expanded into Southeast Asia can bring big growth, but it also has risk. Using about Varuna said 60% of equity and 40% debt will keep the company's finance balanced and safe. The major banks should guide them and choosing the best way to raise fund, IPO and private placements, agree the project loans and find local partners into the handle the rules and operations by managing risk like currency changes and political issues and improving current project through free up money, tech can grow successfully and keep innovative projects.